Welcome back to the Investor Professor podcast. This is Dr. Ryan Peckham, and this is episode 184. On today's episode, we'll talk about Netflix backing away from Warner Brothers Discovery, and we will talk about the markets being in the negative for the year so far. And of course, we will talk about the Iran war, spiking oil prices, and what impact this could potentially have if it carries on, and what history tells us about these conflicts. So, as always, get your mind right, and let's get to work. Well, welcome back to the podcast, everybody. I'm not sure we've had a year. I think I'm recording these, every week or every 2 weeks and trying to keep up with the news. And I got to tell you, it's pretty hard. I think this is like the most difficult year as far as just keeping up with the news cycle for sure. So much so I've recorded so many of these episodes. This is the second intro I've recorded, or I actually hit play and was recording, or I hit play, thought I was recorded the first segment of this podcast before I realized, oh, I didn't hit record. I just hit play. So even, for all of us, I think it's just been a crazy year so far. So, I recorded episode a couple weeks ago. What's happened, what's transpired between now and then? Well, the big one is the Iran war, which we will, of course, get to here in a moment. But I do want to talk about one business story that I think is important that's kind of been buried now in the news, if you will. But that is the fact that Netflix stepped away from the offer for Warner Brothers Discovery. So if you remember, Netflix was going to try to buy Warner Brothers Discovery. They got in kind of a bidding war, if you will, with Paramount. Paramount came back with what was deemed a superior offer, and Netflix said, that's it. That's enough for us. And Netflix walked away. There's a really good article you can go look up that discusses Netflix walking away. And the co-CEO for Netflix discusses, man, we had a number and they went above that number, and we knew right away when they matched that or that they came back that we were going to step away and say this is too much. And there's a lot of good business points here, which is when you're going after something, looking at buying something or whatever, you got to know what your number is, and you got to say, okay, if we don't get this, we got to be willing to walk away. So you see this happen, if you're doing an auction or if you're buying a house or whatever, where, all of a sudden it becomes not about the item that you're trying to get, but it becomes more about trying to beat the other person and, win the item or win the house or win the business or whatever it might be. And so that, usually leads to some buyer's remorse, is what the academic studies show, is that can lead to buyer's remorse. And so I thought that this is just a really good case study on Netflix saying, man, we put ourselves out there. This is what we wanted to pay. Another company came and offered more, and they were willing to walk away. Now, the repercussions of this are going to be interesting over the next number of years, because for Paramount to buy Warner Brothers Discovery at that price, I think it's $31 a share. And by the way, most people, or most, of those in the business thought that Warner Brothers might sell for like 19 a share. So the fact that they're going for like 31 is a lot higher than what was expected in the beginning. So, but in order for Paramount to buy Warner Brothers Discovery, they are going to have to be like 6 or 7 times levered in order to do that. So that means they are going to borrow a ton of money in order to make this happen, and then once they do that, they are still going to have to compete against Netflix in just normal commerce. But they're going to do it from a much more weakened position as far as, the amount of debt that they're going to have buying Warner Brothers Discovery. I'm just amazed. If you look at all the companies that have bought Warner Brothers Discovery, the most recent one, which was AT&T, that took on a lot of debt to buy Warner Brothers Discovery as well. And it just hasn't worked out for those companies. When you borrow too much money to buy these companies, it becomes harder long term to be profitable, because when you borrow a lot of money you are committing future cash flows to that debt service. And so in order for this to really work for Paramount, they're going to have to cut expenses. What's the easiest expense to cut? That would be letting people go. That would be maybe getting rid of some projects or whatever. So it's going to be, I don't know. I've said this word too many times already, but it's going to be interesting to see how this works. It puts Netflix in a pretty good spot. You will notice that when Netflix started talking about buying Warner Brothers Discovery, their stock was about $130 a share. It had dropped all the way to like 75 because of the amount of debt and cash they were going to have to use to make this acquisition. And so if you look right now, Netflix stock is around $98, $99 a share. And I kind of brought it up before that I thought, man, that looks like a pretty good entry point for Netflix. And then now that they're not going to have, they're not going to have to spend all the cash and do all the things to bring on Warner Brothers Discovery. I mean, Paramount, Warner Brothers Discovery, they're still going to have to sell content to Netflix. So I think that that's going to be kind of a place to maybe look. I think this could be one of the best things to happen to Netflix, because they have a competitor taking on all this debt to buy this company, and then they're going to have to turn around and they're going to have to compete against Netflix. So we will see, but just, always trying to look for opportunity, which in a market that we're in right now seems to be a little bit more challenging. So after, don't worry, we're about to get into the Iran war, but you look at the markets this week, and we now have every major index in the red for the year. So the NASDAQ is now down 3.68%. We have the S&P 500 down 1.5%. And the Dow Jones, which held on the longest, it is still at, I think it's actually positive, 1.17%. So, we're barely kind of hanging on here. And so you look at, the Iran war and what is the impact of that going to be on the market. So good or bad, it's going to have an impact. What is most likely going to happen? Well, some of this I'm about to tell you, you've probably already seen, you've probably already heard if you're watching any of the news. But this past week you had oil spike 35% is how much oil prices spiked for the largest 1 week gain ever. So that is going to have consequences at gas pumps around the world, and diesel prices and natural gas prices. All of those things are going to be very much impacted the longer that this goes on. So the Strait of Hormuz, which is where a lot of oil gets, basically starts and then gets shipped around the world. So that's that strait that you hear all the time that is right there next to Iran. That is where 30% of the world's oil supply passes through there. It's also where 20% of natural gas passes through there. So, you look and see what were the stocks that did well this past week. Well, obviously, you see oil stocks going up. You see natural gas stocks going up, like Cheniere. Their symbol is LNG, which is, short for liquefied natural gas. You also see defense stocks going up. So you see, Raytheon and Lockheed Martin and Northrop Grumman and some of those stocks going up as well. And my advice to you on this is be very careful what you chase. And there are repercussions from that. If there were to be some kind of de-escalation in the region, if you think, what do you think would happen to oil prices if, all of a sudden you hear that there's peace talks? You can pretty much guarantee that oil will drop immediately by 8 to 10%, I would expect. So be very careful about chasing, changing strategies, those kind of things. If you go back and look through history and you look at some of the other ones, so this would be 1991 with Desert Storm, 2003 with Iraq, 2001 with Afghanistan. I mean, even going back to, 1941 with Pearl Harbor. I mean, most of the time, these conflicts have short-term impacts on the market as a whole. But obviously, there's going to be rotations that occur, and you just have to be careful that you don't rotate your portfolio too much, and you don't chase and you don't trade the headlines too much. So even this past week, I think Exxon, let me look here. I believe Exxon closed the week at 150. Let's see. Man, my computer is slow. Should have looked this up beforehand. See, it's teaching me a lesson right here. So Exxon closed the week at 151.21. But if you look over the last 5 days, when it first actually opened on Monday, because all the investors flooded into oil and gas stocks, it got as high as 160 and then actually traded down for the week. So that's what I mean when I say you got to be careful about like not just chasing things based on headlines. So obviously if the war continues and gas prices stay elevated, I think oil right now is around $91 a barrel. It'll probably hit 100 this week, which is going to have repercussions as well. So you think about what stocks, when oil spikes up, what gets moved around? Well, obviously oil and gas stocks are going to go up. You're going to have defense contractors because of the war go up. But you look, airlines are going to be down, right? So the number one source expense for airlines is going to be fuel. So jet fuel is obviously going to go up, which means long term, that means your airline tickets are going to be more expensive. It also means that shipping costs are going to go up. So whether that's for food or just for oil and gas as well, there's some oil and gas shipping companies you should know about. Frontline is probably one of the most popular that you can go look at. There's the food cost with fertilizer. Transporting food means that food prices could go up even more. Manufacturing costs could spike as well. So really this comes down to basically being another tax on consumers with the cost of goods going up. So you partner that with tariffs that have also made, some items go up. And again, what it ends up meaning is that for most, everyday citizens, that their discretionary income is going to go down, which means they're going to have less money to spend on non-essential items. Their vacations are about to get more expensive. And all of a sudden, so companies that are selling, discretionary type items means that their revenue is probably going to drop. Their margins, if they have to get competitive on pricing, means their margins are going to come down. So long term, this could, shift and shape where consumers' money is going to go. And it also is going to impact, this is months away, so there's a lot of things that could happen from this. But it also could impact the Fed and what they want to do with interest rates. This past week, we got kind of a negative jobs number that there was more job loss than was expected. And so that has that has an impact, because if you're a business, think you're a business owner and you don't know what's going to happen with tariffs. You don't know what's going to happen with the Iran war. You don't really are you wanting to hire employees? Are you wanting to, be aggressive, hiring employees, expanding your business? Or are you wanting to be like, hey, I'm just going to wait and see. I'm going to ride this thing out. I want to see what's going to go on here. And so in the initial weeks, that's really going to be, a big impact. Is there's going to be a lot of investors. There's going to be a lot of business owners. There's going to be a lot of people within business that just say, hey, I'm going to see what happens over the next week or two. And I think that when you look at the market, if you've been paying attention, we have one good day, one bad day, one good day, one bad day. And it's like, does it look like this is going to be over quick? No, it looks like it's going to drag on. So it's like, if it looks like it's going to be over quick, you see the market rally. If it doesn't look like it's going to be over quick, you see the market pull back. And so there's just this 2 steps forward, 1 step back that we've kind of seen the rest of the year, which, as from an investor standpoint, makes it a little hard to be like, man, I really want to, put a lot of money into the market here. So, this is where we think about, okay, what are companies that have to be, that individuals have to spend money on? I do think that the defense stocks long term, I don't know, I probably would not chase them here. So I'm going to say that I would not chase the defense companies here. But later on, when it looks like there's going to be peace and investors that are not long-term focused sell out of the defense stocks and go put their money other places or rotate back into technology or wherever, I mean, that's going to be when it's the time to invest in some of these defense companies, because it is going to take them a number of years to make all the stuff that we've been using over the past couple of weeks. Not only that, the stuff that we've sent to Ukraine to help them fight the Russians, the stuff we'd already sent to Israel, and now all the stuff, all the missiles and everything that we're using in Iran. I mean, it's going to take a while for these things to get remanufactured over time. So if you see a rotation out of defense and it looks like the war is going to end and, there's this all clear, later on, back your mind to be thinking about that as far as a potential investment later on. As far as, what to do now, I mean, this is, you buy, if you're investing, you buy small, you buy, maybe a little bit, you look where places where the money is coming from. So if you have all this money that's flowing into the oil stocks and the defense stocks, where are they selling? Well, we've seen some weakness in tech already this year. I mean, there's, some very good companies out there that I don't think are going to be at this discounted rate for forever. And so if there's some companies out there that haven't done well this year that you're really interested in owning, now's the time to kind of look at them and think about buying some shares. So it's all about, kind of keeping your emotional intelligence, thinking about things and kind of not making sure you don't just throw your entire strategy out because of, some things that are going on around the world. And that is very difficult for most investors to think about. Like it's, that you're emotionally, it pulls you in and you think, man, I got to do something. I got to take advantage of this, or I got to protect myself from this or whatnot. But this is a lot of times where, this is where investors hurt themselves because they do something that is impulsive, that they don't really think through, and they end up costing themselves a couple percent or whatever. But when you look at the charts of if you stay invested for 20 years, how do you do versus if you miss the 10 best days in the market? I mean, if you miss the 10 best days in the market over a 20-year period of time, you almost cut your performance in half. So you have to be very careful about not doing something drastic in these times. But little bitty things, trading around positions, looking where other people aren't, investing in companies that other people might not be paying attention to while they chase oil and gas, and those could allow you to have a little bit more success in your investments. So, as we look here, most of the time it's a horrible thing. Like, war is never good, and I mean, it always is going to have some kind of there's going to be some kind of impact down the road. So you just have to be mindful that normally these things kind of work themselves out, and so you don't have to completely redo your position. But this is a pretty tough year just as far as just news flow is concerned. I mean, we have gone from, I don't know, what have we talked about already this year? Greenland and Venezuela and Mexico and tariffs and, everything. And it's March 8th. I mean, so we've barely gotten into this, and it seems like we've had a full year's worth of stories condensed down into about 9 weeks. So, but that's the update for this week. I hope this was helpful for you. As always, don't mistake activity for achievement, and I will see you next time. Thanks, everybody. This podcast contains general information that may not be suitable for everyone. The information contained here should not be construed as personalized investment advice. There is no guarantee that the views and opinions expressed in this podcast will come to pass. Investing in the stock market involves gains and losses and may not be suitable for all investors. Information presented here is subject to change without notice and should not be considered as a solicitation to buy or sell any security. Right R Equities does not offer legal or tax advice. Please consult the appropriate professional regarding your individual circumstance. Past performance is no guarantee of future results.